Douglas Renwick is Senior Director from Fitch Sovereigns team. He joins us now. Welcome to the Pulse, Douglas. 3 notches is the cut. Negative outlook. You say the investment grade rating on Spain is premised on the EMU remaining intact. So if Greece leaves, if Greece exits, would that mean we could see it cut to non-investment grade?
What we've said about Greek exit is that it would be very negative for the Eurozone as a whole. So we think that the potential for contagion to other countries is significant. So something we announced about a month ago is that if Greece was to exit, we would review all of our Eurozone ratings. And those in the most pressure from a financing point of view, so we're talking about Cyprus, which is directly exposed, but also Ireland, Portugal, Greece, Spain and Italy also obviously seeing capital outflows. Those ratings would come under pressure if Greece left, yeah.
And so only 2 notches off non-investment grade, it could see it falling into the junk category?
Well, it would really depend on what the policy response at the European level was. If Greece exited and there was a very strong positive policy shock, so an announcement that brought us something closer to banking union, something closer to more of a pooling of liabilities within the Eurozone, then it needn't be such a negative event for other ratings. If, on the other hand, the policy reaction was insufficient and you saw serious contagion in the rest of the periphery, it would have more pressure on those ratings. Yeah.
Talking about policy reaction, because I thought that was really interesting part of what you've been discussing about Spain, was that the lack of action, the lack of action from the likes of the EU level is, to a certain extent, why we've seen such rating depreciation, such a fall-off in the credit ratings of Spain. What do you think needs to be done by the EU levels, or what has been the misconduct? What have they missed?
I mean, we could emphasise that they have done some positive things, and that we're a lot further towards the sort of end game for the Eurozone, you know, the union that actually functions properly than we were, say, a year or 2 years ago. So we have a bailout fund that is able to provide liquidity to struggling sovereigns. We're probably moving more towards pooling of banking liabilities. So there've been positive steps made, but the trouble is it's never going to be a very proactive response, because clearly it's politically very difficult decisions to be made. So these decisions get made in a very reactive way. So it's only when market pressure reaches sort of fever pitch that another step forward happens. So we expect this kind of process to continue over the next few years.
A lot of your focus has been on the banking industry, of course. Not only your focus, but investors' minds. It's been really in the forefront. What do you think now the probability of an external financial support for Spain is? And what sort of form do you think it will take? Will it take a full-on government bailout? Will it go direct to the banks?
That's a good question, because there are lots of different types of bailouts you can have. We don't think Spain would have a bailout in the same way Portugal or Ireland has, so we don't think they'll just be taken out of the market. They do need to raise money to recapitalise the banks. In our view, part of the rationale for the downgrade yesterday was that we expect around about 60 billion euros of extra capital to be required for the banks. That's going to need to come from the government. But the government needs to raise that themselves. If it struggles to do that on the market, then the next step is to ask for an official loan to help recapitalise the banks from the EFSF. Would
the official request for a bailout impact the ratings at all? Would that send it into junk? There's been lots of speculation.
If they got a loan to support the banks, that wouldn't impact the rating. This is something that would be within the tolerance of that rating.
I see. So only if it went direct to the government would it be an impact on the sovereign ratings?
If they were unable to fund themselves, even for their day-to-day budgetary requirements, we'd have to review the rating again.
And Douglas, you talk about their 60 billion euros is how much, on a base case scenario, you assume it would cost to bail out the banks. Worst case scenario, 100 billion euros, that's about 9% of GDP, you say. What would prompt the worst case scenario?
I think there we're really looking at applying Irish-style default rates in bank assets to Spain. And so the reason that's conservative is that lending standards in Ireland were quite low in a lot of cases. It's not quite as bad in Spain, so we wouldn't expect to see NPLs for residential mortgages hitting the double digits as we've seen in Ireland. But were that to happen, you'd be looking more about 90 or 100 billion.
I see, so only if non-performing loans deteriorated significantly.
Further than we would expect, yes.
You say government debt could peak at 95% of GDP by 2015 if it was 60 billion euros bailout. Have you got an estimate if it was 100 billion euros, if it was your worst case scenario?
then you'd be adding, it would be closer to 100% of GDP, basically, under that worst case scenario. But the other drivers of the debt dynamics there are the growth and their ability to cut their deficit. So those two things are at least as important as how much they're putting into the banks.
And also you've noted regional governments. They've been continuing to weigh on the credit profile of the sovereign overall. What do you want to see from the regions to improve their credit worthiness and then feed up into the sovereign?
I think there's a lot of structural reform on the expenditure side that the regions are going to need to carry out over the next couple of years, because regions have to stick to their own medium-term plans. So it's kind of like a mini stability and growth program within Spain. But unlike on the EU level, where different countries have different speeds of adjustment, different deficit reductions, in Spain they pretty much all have to get 1.5% deficit next year, no matter how high their starting point was. So it's going to be a real struggle to get that on target this year, and we anticipate some slippage at the regional level.
So slippage at the regional level. But what is notable is Spain has been trying to force through improvements to competitiveness. They have been making marked reforms to their labour markets, etc. Are they doing that quickly enough to perhaps not see the recession extending into 2013, or are you sure that the recession will extend for another year?
We think it will extend for another year, and the reason is structural reforms that they're doing are beneficial. They have a long-term benefit, but in the very near term, they're not going to support growth. So it's the time scale of growth now versus longer-term growth in the future. So they're laying the framework for a more sustainable growth towards the end of the decade. But right now, the fiscal consolidation is going to cause, primarily anyway, going to cause the GDP to contract this year and next year, in our view.
Douglas Renwick, thank you very much for joining us to go into the details of your rating downgrade of Spain.